All right, sorry for sure. Like I said last week, we started with the first topics of finance. A quick recap of our last discussion. We started by defining what is financial management. Financial management, a component of company's management that focuses on how to source finance, how to utilize finance so as to meet the business objective of an enterprise. We define financial management. Oh, okay. Please confirm you can hear me.
I hear you loud and clear, sir.
Okay,
yes,
please.
you're audible.
I can see a message from a student saying we can't hear you. All right, let's continue with the class. Having defined financial management, we now look at the first topic, sources of financing. Under this topic, we discuss how company can source finance. What are the various methods of financing? How can companies source finance for business purposes? We discuss equity financing. Under equity financing, equity financing, finance contributed to the business by the owners of the business. Who are the owners of the business? Excuse me, please. The shareholders. Equity financing refers to the finance contributed to the business by the owners of the business. Under equity financing, we discuss retained earnings. We discuss issue of shares. Companies can issue new shares for the purpose of raising finance. Under issue of new shares, we discuss public offer, that is offer for public subscription. We discuss private placing. We discuss private placing. We also discuss rights issue. We explain that public offer, when you issue new shares to general public, that is public offer. Private placing, the issuing of new shares to a relatively small number of selected investors. We discuss this. We equally discuss rights issue. Under the rights issue, that rights issue, you are issuing new shares to existing shareholders, usually at a reduced price. We discuss this. Under the rights issue, we discuss theoretical ex-right price. That is the expected share price after the completion of the rights issue. We now look at debt financing. Under the debt financing, we explain that debt finance, you can classify into short-term debt financing, and long-term debt financing. Short-term debt financing, we discuss bank overdraft, short-term borrowings, trade credits, debt factoring, and operating lease. Thereafter, we move to long-term debt financing. Under the long-term debt financing, we explain that debt financing, long-term, we can classify into two: marketable debt security and non-marketable debt security. We explain marketable debt security. These are debts that are tradable. These are debt instruments that can be traded at the debt market. These are debt instruments that are tradable at the debt market. We explain this. The debt, tradable debt, we discuss bond, debentures, loan stock, loan notes. And we explain that these instruments can be traded. These instruments can be bought or sold for the purpose of borrowing money. We explain this. We also explain non-marketable debt security. Debt security that are not tradable. A good example is the bank loan. Long-term bank loan are non-tradable. We discussed this last week. We now rounded up the class with Islamic financing. Islamic finance based on the principle of Islamic law. That is the principle of Islamic Sharia. Under this finance, interest payments or acceptance is completely prohibited. Under the Islamic finance, lending and borrowing do not involve interest payments or interest acceptance. We also discussed that Islamic finance can only be used to finance Islamically accepted products or services. In other words, Islamic finance can only be used to finance businesses or companies or projects that is in conformity with Islamic principle. For example, alcoholic business is regarded as unethical and injurious to the public. Under the Islamic finance, alcoholic business is regarded as a prohibited business. Unlike the conventional financing, you can use conventional financing to finance any legal business. But Islamic finance can only be used for ethically acceptable Islamic businesses. For example, gambling, like Naira bets, Niger bets. Under the conventional financing, bank can give loan to Naira bets. But under the Islamic financing, that business is completely prohibited. Gambling is regarded as a form of cheating. Hence, Islamic finance cannot be used for such business. We now discuss Islamic products, Islamic finance products. We discussed this last week. We discussed Musharaka products, a partnership banking, where the bank and the customer jointly finance a business. And if a profit is achieved, both the bank and the customer will share the profits. If a loss is incurred, both the bank and the customer will also share the loss. That is musharaka. We have mudaraba, profit sharing and loss bearing contracts. Under these contracts, one party will supply the finance. That is the capital owner. A party provides finance for the business, while the other party provides effort and management expertise to manage the business. If a profit is achieved, both the capital owner, that is the bank, and the customer will share the profits. But if a loss is incurred, only the capital owner will bear the entire loss. We discuss this. We equally discuss Muraba and Islamic or Sharia compliant sales transaction used in trade and asset financing. Ijaro is an operating lease. Excuse me, please. Ijaro is essentially an operating lease. A rental agreement for the use of non-current assets. There's a rental agreement between the lessee and the lessor for the use of the lessor assets. In exchange, the lessee will pay a renter, that is ijaro. And we discuss sukuk, Islamic equivalent of bond financing. Sukuk is an Islamic bond, but this sukuk is asset-backed debt security. Sukuk is an asset-backed debt security. What does this mean? We explained this last week, whereby government want to finance a project like a project of public interest now. A project of public interest. For example, construction of hostel at the university. Government is looking for money to construct hostel at university. Government can decide to issue sukuk to the public. The public can invest in this sukuk. The investor are the owner of that hostel. If the money is generated from the investor, the hostel will be constructed for use, for the use of the students. That hostel belongs to the investor in the bond. This hostel will be given out to students at a fee. The income generated from that hostel will be divided into two. One for the maintenance of the hostel, then the other will serve as return to the investor. That is why we call it asset back. There's an asset to be financed. The asset is the hostel. The investor have partial ownership in that hostel. The debt will not be repaid. The hostel will be there forever. And this hostel will continue to generate income from student usage year in, year out. Returns will be paid to the investor. This is the concept of sukuk. Sukuk has been used to finance many projects in Nigeria. This is the discussion we had last week. All right. Any question, please? Any question? All right. If there's no question, let us refer to our study pack. Let us refer to our study pack, page 95. Question number 1. Please that page. that page quickly. Let me check here. Oh, no. Page 137. Not 95, please. Like 130 something here. Okay. Okay, page 139. Page 139, question number 1. Banco. Page 139, question 1. Banco. Please, can we confirm the page so that we can move on with the class? Hello.
Hello, sir.
Hello.
Hello, we can hear you now.
Can someone confirm the page?
Page 140. We are with you, sir.
All right, let's go on with the class. All right. Please, as much as possible, let us try to follow the question. It's expected that you are going to open the question on your laptop. Let's continue with the class. As much as possible, please pay attention to the reading so as to make it much easier for everybody. Banco is a stock exchange listed company that is concerned
We can't hear you.
All right, let's continue with the class. We have to face the reality of the online class. Occasionally, we might have network glitch. We can only hope that it's not terribly bad. Banco is a stock exchange listed company that is concerned with its current level of debt finance. Look at that sentence. The company is concerned with its current level of debt finance. It plans to make a rights issue and to use the funds raised to pay off some of its existing debt. And look at that again. The plan is to make a rights issue and to use the funds raised to pay off some of its existing debt. The rights issue will be at 20% discount to its current ex-dividend share price, £7.50 per share. Banco plans to raise 90 million naira. The company believes that paying off some of its debt will not affect its price earning ratio, which is expected to remain constant. Right. We are giving the statement of profit or loss information. You have the revenue, cost of sales, profit before interest and tax. You have the interest, and you have profit before tax, the tax payable, profit after tax. Again, you have the statement of financial position. Ordinary shares, £1 nominal value, total nominal value 60 million. Reserves, we have long-term liability, 8% bond, in brackets, 100. So I was trying to explain bond. So the face value is either 100 naira or 1,000. Now please note, where the examiner is silent about the face value, you can either assume 100 naira or 1,000. All right, let's continue. The last paragraph. The 8% bond is currently trading at 112.5 naira per 100 naira bond. That is the current price of the bond, 112.50. The bond holders have agreed that they will allow Bar and Co to buy back the bond at this market value. Bar and Co pays tax at a rate of 30%. Before we go to the requirements, when we say buyback or repurchase, a company has issued bond. That means the company has issued bond for the purpose of borrowing money. Some years later, you decided to buy back. Buying back means you are repaying the debt. You are repaying the amount you have borrowed to the investor. So the meaning of buying back is repaying your loan. You are repaying your loan before maturity. That is the meaning of buyback. All right. Let's go to the requirements. Requirement 1 says, calculate the theoretical ex-right price. The theoretical ex-right price per share. No, this will be theoretical ex-right price. Theoretical ex-right price per share of Bar and Co. following the right issue. Let us deal with this first. In my usual manner, before I go to solving question, I try to explain the requirements first. Examiner says, calculate theoretical ex-right price. For me to calculate theoretical ex-right price, I will ask myself, what is the meaning of theoretical ex-right price? Before I can go ahead to compute theoretical ex-right price, I'm going to ask myself, what is the meaning of theoretical ex-right price? We explained this last week. Theoretical ex-right price is the estimated share price after the completion of a right issue. Theoretical ex-right price, the estimated or the expected share price after the completion of the right issue. We now explain what is right issue. We said right issue is the issuing of new shares to existing shareholders. You are issuing new shares to existing shareholders. For you to talk of right issue, the company must have shares in existence. For you to be talking of right issue, that company must have shares in existence. The existing shares must have a price. You are now issuing new shares at a reduced price. That means we have existing shares at a particular price. We have new shares at a reduced price. We now want to calculate the expected share price after we have completed the right issue. We want to estimate what the share price will be after the completion of the right issue. I haven't explained this. How can we calculate theoretical ex-right price? Please, Very, very important. Direct in, direct out. A question will be tested on this. Last diet, it was part of question 7. Even at the professional level. And please don't forget, this knowledge you are getting now, you are still going to require it when you get to the final stage. All right, let's go to the solution. Requirement 1. Let me take my pen, please. One. Calculation of theoretical let's move on. Anyhow, we are going to achieve the objective of this lecture. Now, please refer to the statement of financial position. Please refer number of existing shares. Let us go to the statement of financial position. Look at it. Ordinary shares, 1 naira nominal value. Total nominal value, 60 million. Please, how many shares do we have in this company?
60 million shares.
Hello. 60 million shares. Thank you. Just pick the total naira value, divide by the nominal value per share. We have 60 million shares. Next. Current price. Current market price of existing shares. Again, return to the question. What is the market price per existing shares? Look at it here. Examiner says the right issue will be at 20% discount to its current dividend share price of 7 naira 50 kobo per share. That is the current market price
of existing shares. We also require that information. 7.5. Please, let's continue. We got to deal with the risk of network. Somebody is touching my screen. Why? Oh, the person has made a red mark on my screen. All right. Number of new shares in a right issue. Let's go to it. Then we also require. Okay, let's go to the question. Look at it. Examiner says the right issue will be at 20% discount to its current ex-dividend share price of 7 naira 50 kobo. That means we can determine the price per new share. 20% discount to the current market price. That means you are going to take 20% off 7.5. That is the price of new shares. Note that. Then look at this. Banco plan to raise 90 million naira. Examiner didn't give us the number of new shares. Examiner did not give us the number of new shares directly, but we can work it out. Look at this, please. I can come here and say issue price of new per new share. Issue price per new share. Examiner say 20% discount. Please compute 20% of 7.5 and remove it from 7.5. If I take 20% discount, that means I'm left with 80%. Please work this out. 80% of 7.5.
6
What
naira.
do you have, please? That will give you 6 naira. If you are wondering how we get 6 naira, you can do like this. First, 20% of 7.5. That will give you 1.5. Now calculate new price. New price is equal to 7.5 minus 1.5. That will give you 6.0. That is the issue price per new share. Now, number of new shares. Number of new shares. Million naira. And the price per share is 6 naira. How many shares do we need to issue? At 6 naira per share, that will give us 90 million naira. Let me take that again. Our plan is to generate 90 million naira. And the price per share is 6 naira. Price per new share. How many shares are we going to issue? At 6 naira per share, that will give us 90 million naira. Please compute and tell me. Please compute and tell me. Oh yeah. Please, this is what you need to do. 90 million divided by 6 naira.
15 million.
15 million shares. You have done a work back. We need to issue 50 million shares at a price of 6 naira per share to be able to generate 90 million naira. These 4 very existing shares, yes, number of new shares in a right issue, the issue price per new shares, all variables to calculate theoretical ex-right price. You require these 4 variables for you to calculate ex-right price. We can now go to the calculation. These 4 variables are needed for the computation of theoretical ex-right price. You can now come in. Theoretical ex-right price. That is the shortening. We have item, quantity, price, and value. Number of existing shares, 60 million shares. Current price per share, 7 naira 50 kobo. Number of new shares, $15 million new shares at a price of 6 naira. Now multiply. 60 million multiplied by 7.5. Total value, please.
450.
15 multiplied by 6. This is 450 million. Thank you. Now sum your quantity. After the right issue, total shares become 75 million. Total value becomes 540 million. Please don't sum price. You're only going to add quantity and value. Now you now want to calculate your theoretical X right price. This is equal to, let me create space again, because this working is something that is important. We understand how to complete it. Yes. Your question, your comments?
Sir, please, can you re-explain this theoretical S-right price? My network went off.
All right, no problem. Total value over total quantity. That is 540 million divided by 75 million. Please work this out.
7.2 million.
7 naira 20 kobo.
Sorry,
How are you there?
Yes, sir.
Theoretical X rights price. That is 7 naira 20 kobo. That is the expected share price. All right. According to the students, it should be an edu person. It's just saying. He said, let's try to re-explain the meaning of theoretical S-right price. That's fine. We said theoretical S-right price, the expected share price.
Hello, sir.
Yes, please.
Sorry, sir. I made
Your network is still breaking, oh.
the calculation you just did, the theoretical
The calculation is your concern, Abi.
yes, so
Right.
the above calculation that you just did.
Okay, what we are saying is this. If you are to calculate theoretical X-right price, you require 4 variables. If you are to calculate theoretical X right price, you require 4 variables. What are these variables? 1, number of existing shares. That is, how many shares do we have in the company before? Before the right issue, how many shares do we have? Number of existing shares. To get this information, go to the balance sheets or statement of financial position. Look at it. Ordinary shares, 1 naira nominal value, total amount 60 million. To get number of shares, 60 divided by 1 naira, that will give you 60 million shares. That is the number of shares in existence before the right issue. Next, what is the price per share? Current, please note it. We have nominal price. This 1 naira is nominal price. The price in the balance sheet. That is the nominal price. We now go and look for the stock market price. That is what we call current market price. So variable 2 that you require, the current market price of the existing shares. Look at it here. The right issue will be at 20% discount to the current dividend share price of 7 naira 50 kobo per share. That is the current market price of the existing shares. That is variable 2 required. Variable 3. What is the issue price? Issue price of the new shares. The right issue will be at 20% discount. That means the new shares will be at 20% discount to the current market price of 7 naira 50 kobo. We now computed. Look at it. Issue price per new shares. 50% of 7.5. That is 20% has been discounted. Out of 100%, remove 20% discount. That means you are left with 80%. 80% of 7.5. That gave us 6 naira. Alternatively, you can first do 20% of 7.5. That will give you 1.5. 1 naira 50 kobo. Now deduct this from 7.5. That will still give you 6 naira. Then, number of new shares. Number of new shares. How many new shares will the company issue? We are not giving this information in the question directly. We are not giving this information in the question directly. Examiner said the company wants to generate 90 million naira from the right issue. You are going to issue new share at 6 naira per share, and you must realize 90 million naira. How many new shares do we have to issue? At 6 naira, that will equal 90 million naira. We now did a walk back. 90 million naira divided by 6 naira. That gave us 15 million shares. That was the 4 variables that we explained. Is that better, please?
Yes, sir.
All right. So we have resolved requirements A. Requirement B. Requirement 2. Examiner says calculate and discuss whether using the cash raised by the right issue to buy back bonds is likely to be financially acceptable to the shareholders of Banco. Look at that requirement. calculate and discuss whether using the cash raised by the rights issue to buy back bond is likely to be financially acceptable to shareholders of Bar and Co. Commenting on your answer on the belief that current price earning ratio will remain constant. Unlike question one is very direct. Question one is just 3 marks. Question number 2 is awarded 13 marks. That means we need to do some work here. Let us now try to break it down. Also, you also try to break the question down to your understanding. This company is planning to do rights issue. The company is planning to issue new shares to existing shareholders. The company will generate 90 million naira. This money will be used to repay our bond, our debt. Now the question is, examiner says, calculate and discuss whether using the cash raised by the rights issue to buy back bond is likely to be financially acceptable to the shareholders. If you raise money from rights issue, you are collecting money from shareholders, more money. You now want to use the money to repay your debts. Now the question is this plan likely to be financially acceptable to the shareholder? Will shareholders be happy with this plan? You now ask yourself, how do we tackle this question? What do we need to calculate to be able to tackle the question? You can now ask yourself, what is the objective of shareholders? They want to maximize their wealth. The objective of investor, the equity shareholders, is to maximize their money. For me to answer this question now, I will now ask myself, will this proposal increase the wealth of the shareholder or reduce the wealth of the shareholder? Are you there, please? Because some question will come to you applied. The purpose of investing in a company is to maximize my wealth. If the company is planning to repay the debt, the shareholders will now ask themselves, will this proposal repaying the debt, will it maximize our wealth, or will this reduce our wealth? The next question will now be, what constitutes wealth to shareholder? The next question is, what represents wealth to shareholders? How can we measure the wealth of the shareholders? We can look at any spreadsheet. If the earnings per share is increasing, that means the wealth of the shareholder is increasing. But if the earnings per share is falling, that implies that the wealth of the shareholder is reducing. That means for this question, requirement 2, we need to know what is the earnings per share currently. Currently means before the right issue. What is earnings per share? After right issue, what is earnings per share? What we are trying to determine if this proposal will increase earnings per share or will reduce earnings per share. So as to be able to say that this proposal is financially acceptable or not financially acceptable. Is my explanation clear, please?
No, sir.
Emeka, are you just joining the class?
Yes, sir.
Okay, at least it's better, because if you have started the class with us, it should be clear. Okay? Let's try and re-explain this. But please try to look at the requirements. And that is the challenge now. No. Somebody joined the class an hour later. Now look at requirement 2. Calculate and discuss whether using the cash raised by the rights issue to buy back the bond is likely to be financially acceptable to the shareholders. Like I explained, this question, the company is planning to do right issue, issuing new shares to existing shareholders for the purpose of raising finance. For the purpose of raising finance, the company is planning to do right issue. And we explain right issue, issuing new shares to existing shareholders. When we generate the money, the company is planning to pay back its debt. That means equity shares will increase, debt will reduce. Now the examiner is now asking you, this proposal to increase our equity and reduce the debt, will this proposal be financially acceptable to shareholders? To answer this question, you now ask yourself, will this proposal increase the wealth of the shareholder or reduce the wealth of the shareholder? If the proposal increase the wealth of the shareholder, that means the proposal will be financially acceptable to the shareholders. But if the proposal reduces the wealth of the shareholder, that means the proposal will not be financially acceptable to the shareholders. We now said, how do we determine the wealth of the shareholders? How can we determine the wealth of the shareholders? We can use earnings per share. The earnings per share, we are going to look at earnings per share before the proposal. And earnings per share, if the proposal is executed, earnings per share, if the proposal is implemented, we now compare the two earnings per share. If the earnings per share is increasing, that means the proposal is financially acceptable. But if the earnings per share is falling, that means the proposal is not financially acceptable. Please, just 1 minute. How that is better. Let's go on with the class. Let's go on with the class. So, back to our working page. Now look at this. Financial acceptability to shareholders of buying back the bond. The financial acceptability to shareholders of buying back the bond can be assessed by calculating whether shareholders' wealth is increased or decreased as a result of the proposal. All right. Now, we need to determine earnings per share. How do we go about this? The bond will be repurchased at a market price of 115, 112.5. We are going to repurchase the bond. We are going to buy back one bond at a market price of 112.5 per bond. The first question is, how many bonds can we repurchase? You have 90 million naira. You are going to buy one bond. You are going to buy back one bond at 112 naira 50 kobo. How many bonds can you repurchase? Please tell me. Remember, we are going to generate 90 million naira. And we are going to buy back one bond at 112 naira point. Ah, 10 o'clock already.
800,000 bonds.
Thank you. Thank you, Mike. You have gotten 90 million naira. You are going to buy back one bond at 112.5. If you work this out, you can buy back 800,000 bonds. Is that clear, please? Now, what is the nominal price per bond? Remember, your balance sheet is maintained at nominal value. Look at it, please. This is the interest. 8%, 100 naira nominal value. What is the nominal value of the bond? Nominal value per bond is 100 naira. And you want to buy back 800,000 bonds. What is the nominal value of the bond? Look at it. Total nominal value. 800,000 multiplied by 100 naira. That will give you 80 million. That is the total nominal value of the bond to be repurchased. That is the total nominal value of the debt to be repaid. Go back to your statements. Total nominal value of the bond, 125 million. Out of this 125, you are going to repay 80 million. What is the outstanding bond?
45 million.
45 million. Look at it, outstanding bond. We have 125 million. We are going to repay 80 million nominal value. That means the outstanding bond is 45 million. You can now come to calculation of earnings per share. Again, and share price. What is the formula for earnings per share? Earnings per share is equal to profit after tax divided by number of ordinary shares. You can multiply by 100. That will take your answer to kobo. You now come in. Before right issue, that is before the proposal. Let's go and check. What is your profit before interest and tax? Go to the income statements you are given. Please look at this. Profit before interest and tax, 49 million. Pick this information. $45 million, 49 million. Please note, right issue, issuing new shares to repay your debt will not affect your operating profits. That means the profit before interest and tax is still 49 million. Let me repeat that point. Issuing new shares to repay debt will not affect your operating profits. Your operating profit is your profit before interest and tax. It's also called operating profits. Now, less interest. Let us go and check. What is the interest? The interest here currently is 10 million. After right issue, we have reduced our debt out of, look at it. Look at it. Out of 125 million, we have repaid 80 million. The outstanding debt is now 45 million. Interest will be calculated on the outstanding debt. What is the interest rate on bond? 8%. Please compute 8% of 45 million. What do we have?
3.6 million.
3.6
million.
million. You put it here. That is because our debt has reduced, our interest expense will definitely reduce. Because the debt, we have repaid some of the debt. The debt before was 125 million. We plan to repay 80 million. That means we are left with 45 million. You now compute 8% of 45 million. You can now get your profit before tax. This will give you 39 million. $45.4 million. Now compute your tax. 30% of 39 million. Please calculate your tax.
11.7 million.
11.7 million. Let's look at what the examiner used currently. I think it was rounded up to a number.
12 million.
Yeah. The examiner used 12 million. That means he rounded it up to the nearest million. We can follow the examiner. So round up to the nearest million. This is 12 million. Now compute 30% of 45.4.
14 million, approximately.
Thank you. Approximately 14 million. Now get your profit after tax.
$27 million.
27 million. Thank you.
31.4
Profit after tax. 31.4
million.
million. Remember, you are trying to calculate EPS. You have gotten profit after tax. Now, number of ordinary shares. Before the right issue, what number of ordinary shares? Look at it here.
16 million.
Thank you. Number of existing shares, 60 million. Years before right issue. Here, this is Naira amount, 60 million shares. After the completion of the right issue, what is the number of shares in the company?
75 million.
Thank you, 75 million. 60 plus 15. Total number of shares, 75 million. Now, please compute your earnings per share. 27 divided by 60, multiplied by 100. What do you have?
Yes, 45%.
What do you have?
45.
45 or 46? Which one am I taking?
45.
45 kobo. Please, not percentage. Oh. The answer will either be in naira or kobo. If you are multiplying by 100, then you are taking the answer to kobo. Next, please compute 31.4 divided by 75. Multiply by 100.
42 kobo.
Thank you. 42 kobo. What will be your comment here now? Before the proposal, the shareholders' earnings per share is 45 kobo. If the proposal is implemented, the shareholder will get 42 kobo per share. Do you think this is financially acceptable to the
No,
shareholder?
sir. No.
No. This will not be financially acceptable to the shareholder. Before, you are paying me 45 kobo per share. If you now do right issue and you repay our debt, and I will be getting 42 kobo per share, this is not financially acceptable. So you have looked at any special. Now, what else? What next? Before we comment, look at this. Examiner put something to us. He said, commenting on your answer on the belief that the current price earning ratio will remain constant. Look at it. You can now ask ourselves, what is the meaning of price earning ratio? How can we compute price earning ratio? What is the significance of price earning ratio to shareholders? although this is a topic on its own, when we get to financial ratios, but we need to explain it first here. Price earning ratio is the most important measure of shareholders' success. The price earning ratio is regarded as the fundamental measure of company's performance. It relates the market price of shares to the earnings generated market value of your investment, to the earnings generated from your investment. The price earning ratio is very important to investor for decision making. If the price earning ratio is high, if the price earning ratio is high, this is an indication that the company is likely to generate higher earnings at future periods. If the price earning ratio is high, that is a confirmation that the company in question is likely to generate higher earnings at future periods. Therefore, investors will be willing to buy the company shares. Alternatively, if the price earning ratio is low, it's an indication that the company is not likely to generate higher earnings at future periods. We have explained price earning ratio. We try to explain the significance of price earning ratio. Next is, how can we calculate price earning ratio? Price earning ratio means market price per share divided by earnings per share. The price earning ratio, please just 1 minute. The market price per share divided by earnings per share. Next, let us go and calculate the price earning ratio. What is the current price earning ratio? That is the price earning ratio before the rights issue. If you look at it, market price per share currently is 7 naira 50 kobo. If I want to compute here now, for currently, that becomes 7 naira 50 kobo divided by, okay, this is in naira. 7 naira 50 kobo. Earnings per share currently 45 kobo. I will now do like this. 0.45. You know why I'm doing 0.45? The share price is given in naira. So I need to convert 45 kobo to naira. I will divide it by 100. We can, okay, let me even do it here. Let me do it here. Let's create space here. Let's create space for the workings. Amen. So we can come here. Is equal to market price per share over earnings per share. So we want to get the current price earning ratio. Our market price is 7 naira 50 kobo. Earnings per share 45 kobo. I cannot be 45 here directly because this is 7 naira 50 kobo. I will now do like this. Naira 0.45. That is 45 kobo. Please work this out. What do we have? What is the price earning ratio? Point what?
67.
16.67. That is the current price earning ratio. Examiner says this ratio will remain unchanged. Look at it here. Commenting on your answer on the belief that the current price earning ratio will remain constant. That means after the right issue, after we have implemented the proposal, the price earning ratio is still 16.67. Ahmed, please, can you mute? If I come here, 16.67, this is times, number of times, 16.67. Share price here is 7 naira 50 kobo. Since we know the price earning ratio after the right issue, we should be able to derive the share price after right issue. Hello? We know the price earning ratio after the proposal has been implemented. Then we can derive the share price after the proposal has been implemented. Look at what we are saying. Ooh. One more. Okay, this is what we are saying. After rights issue, price earning ratio still remain 16.67. Therefore, share price is, look at it too. We said share price over earnings per share is equal to 16.67. And we have derived earnings per share after rights issue. Earnings per share after rights issue, 42 kobo. Please let me take more space. Share price, I don't know. Earnings per share after rights issue, 0.42, 42 kobo, is equal to 16.67. Please, what is share price after rights issue? I can cross multiply now. Share price is equal to 0.42 multiplied by 16.67. What do we have, please?
Seven point zero zero.
7.0. One
Zero
or
zero.
two. Oh, 7.00. That's fine. 7 naira. Look at it. Obviously, the shareholders will not accept this proposal. Before the proposal, earnings per share 45 kobo. If the proposal is implemented, after the proposal, earnings per share 42 kobo. Again, before the right issue, price per share 7.50 naira. If the proposal is implemented and the earnings and price earning ratio remain constant, then share price will fall, share value will fall. We can call it share value. Will this proposal be financially acceptable to the shareholders? The answer is no. You can now do your discussion. We have shown the calculation. Examiner say calculate and discuss. We have calculated earnings per share. Earnings. That is the wealth to shareholders. We have used the earnings per share and price earning ratio remaining constant to determine price per share. This also shows that value per share will fall. This proposal will not be financially acceptable to the shareholder. We cannot look at the discussion. Look at the discussion. The revised earnings per share. Your revised earnings per share is this. That is after the right issue. This is what we call revised share price. 7 naira. The revised share price is less than the theoretical ex-strike price. The theoretical ex-strike price is 7 naira 20 kobo. What is theoretical ex-strike price? Expected share price after the completion of the right issue. We expect the price to be 7 naira 20 kobo. After the right issue, we got 7 naira. That means this proposal is not financially acceptable. So look at it. So the effect of using right issue fund to redeem the bond is to reduce the wealth of the shareholders. From shareholders' perspective, this use of fund cannot be recommended. However, the conclusion depends largely on the assumption that price earning ratio remains constant. As the ratio was used to calculate revised share price. That ratio, price earning ratio, that remained constant was used to calculate the revised share price. In reality, share price after redemption of loan notes, that is bond, the share price after the redemption of bond will be set by the capital markets. It is the stock market that determines share price. It is the market determined share price that will be used to determine the price earning ratio. It is market determines share price that we use to calculate price earning ratio. Rather than using price earning ratio to determine the share price, since the financial risk has reduced, following the redemption of the loan notes, if you repay your debt, your financial risk will reduce. If the financial risk reduces, cost of equity is likely to fall. If the cost of equity falls, share price is likely to rise. Leading to a higher price earning ratio. What we are trying to say here is that the approach we use in calculating the share price is wrong. Stock market price is determined by the capital market, not by using price earning ratio. This tries to explain the limitation of our computations. If we have used that figure, then we can have a more informed position. We are done with that requirement.
Let's look at requirement C. Examiner says, compare and contrast the financial objectives of a stock exchange listed company, such as Banco, and the financial objective of a not-for-profit organization, non-profit organization. This should be not-for-profit, not for, not-for-profit organization, such as large charity. Requirement is very clear. Compare the financial objectives of these two entities. That company is for profit-making purposes, such as Banco. Why a non-for-profit organization, such as large charity, what is their financial objective? We have the explanation here. That we can always read, but let us explain. The solution is here for C. Requirements 3 solution. You can read this, but let me explain. The financial objective of a stock exchange listed company is to maximize shareholders' wealth. The financial objective of a stock exchange listed company is to maximize shareholders' wealth. This objective is usually replaced by the objective of maximizing company share value. If you can maximize share price, assuming you have investments with First Bank and the share price is rising, you'll be happy because your investment value is increasing. Maximizing market value of the company represents maximizing capital gain. Capital gain is the increase in share value. The needs for dividends can be met by recognizing that share prices can be seen as the sum of present value of future dividends. So maximizing the wealth of the shareholders is the main financial objective of the business. So if you are able to maximize share value, you are going to maximize return to shareholders. That is the financial objective of stock exchange listed company. not-for-profit organization seeks to provide services to the public. A non-for-profit organization such as charity, the like of Rotary Club, the like of Yoruba Tennis Club, Ikoyi Club, this organization provides services to the public, and this requires cash income. Therefore, maximizing net cash income is a key financial objective of both non-for-profit organizations as well as stock exchange listed companies. For example, a large charity seeks to raise as more funds as possible in order to achieve its charitable objectives. Which are non-financial in nature. Both organizations need to control the use of cash. Both organizations, whether stock exchange listed company or not-for-profit organization, must design controls over the use of cash. Another key objective for both organizations is to keep spending within budget. Both listed company and charitable organization must keep their spending within the budget limits. They must control their expenditure. The objective of value for money is often identified in connection with not-for-profit organization. For not-for-profit organization, you are not making profits, but you still require cash. Then you must be able to achieve maximizing your net cash income. We can go on. Please don't forget the fact that charitable organization is not established to make profits. The organization requires cash. The organization will incur costs. Therefore, the organization can use budgets to monitor its expenditure. The organization must also eliminate avoidable costs. You can read what is available for us. End up the topic next week. To close the class, any question? Any clarification? Question? Clarification? If
Yes, sir.
none,
Yes, I have a question, sir.
yes, go ahead with your question. Yes, your question?
Okay, please, I wanted to verify, how did you get the 3.6 when you were solving the
Well, we got 3.6. Oh,
yes, for that calculation, thank you.
okay, let's quickly let's put the work in there. How we got 3.6? Let's see if we can create a space for that purpose. Okay. Interest on outstanding bond equal, please just 1 minute before I calculate it. That I'm trying to space it. All right, let me return here. 8% of 45 million. Our outstanding bond is 45 million. After we repay 80 million out of 125. Now work this out. This will give you 3.6 million. Is that fine, please?
Yes, it's fine. Thank you, sir.
And that's a good one anyway. Okay. If there's no question, we shall be stepping out of the classroom. May God give us a better understanding. It's very important that you find a way around it, your weekend, or even your weekdays. Try to review this material. By next week, hopefully we can take 2 questions, then we round up the topic. Let's have a blessed evening. Good night.